Today on the 30-day reset, drivers continue to display high intent even as the competition over new drivers wanes. The combination of winter weather, high demand, and a refinery shutdown prompted the FMCSA to declare a state of emergency. And although we may not see any deflationary activity in the economy anytime soon, we might just be through the worst of rising inflation. I'm Joshua Miller, and this is the 30-day reset. Welcome everyone to the debut edition of the 30-day reset. And as the name implies, our new show here will be back every 30 days or so to give you a kind of overview as to what happened in the previous month. Each month we'll be featuring a breakdown of some trucking and recruiting data, as well as touching on some news stories and checking in with our good friend Jason Miller for his thoughts and an economic update. Now let's kick the show off by diving right into the nitty-gritty. This is Trucking by the Numbers, brought to you by Stratus Strategize. Let's start with a look at driver trends. Overall, the search and click trends are on a similar trajectory, with losses week over week and year over year, but gains when compared to the previous month. Low click costs combined with increased traffic converting at higher rates brought the overall average cost per lead in January to levels not seen since July of 2020. And while lead costs are lower, the lead to hire ratio for company drivers spiked to the highest level on record, leading to increased higher costs in December. However, this could come down to fewer open driver positions and normal seasonal trends. Click costs are dropping to levels not seen in at least a year and a half. As of this filming, search CPC is on pace to hit its second lowest point on record since May of 2020. Facebook looks to be at its lowest point since August of 2020, and display is at its lowest CPC since August of 2021. December bucked the trend of flatlining cost per lead and dropped by 5%, with even further drops in January. All track driver types are seeing CPC decreases of at least 14% and falling to levels not seen since the summer of 2020. Overall hiring costs rose in December, indicating that recruiting departments are converting a smaller percentage of leads into hires than they have since at least back in 2019. A likely cause of this is fewer open positions with the same number of leads flowing in, which has allowed carriers to be a little more selective. December tends to have higher CPH totals since there are fewer orientation dates because of all the holidays, and as a result, we typically expect to see January CPH numbers dip a little bit. Trends on recruiting landing pages and multi-carrier apps indicate that drivers have a high intent to find new jobs, as the number of people visiting recruiting landing pages is spiking at the same time that the conversion rates are very high. In the freight market, FTR continues to caution trucking conditions for carriers are unlikely to be positive until at least late 2024. Diesel price drops could help, but high costs and weak rates are likely to continue on. Improved food, construction, and automotive loadings are also leading FTR to predict a stronger truck loadings outlook for 2023. Total spot rates were down, but that is in keeping with seasonal expectations. Each of the three major segments saw declines in their individual rates, while only refrigerated loads decreased. Truck availability ticked up by around 3% as the ratio of loads to trucks fell to its lowest level seen in the last 8 weeks. In total, spot rates were down, and the overall volume saw steep declines from the week last year and is still trending below the 5-year average. And that's your look at Trucking by the Numbers for this month. Now, let's move on to a few of this month's big headlines. We start in the great state of Wisconsin, where Governor Tony Evers was forced to declare an energy emergency on January 6th. The governor cited a shortage of residential heating fuel as the cause for his declaration. Due to the order, those drivers in the process of obtaining or hauling residential heating fuel in the state are hereby exempted from the federal hours of service regulations. According to the declaration, the exemption will remain in place, and I quote, as long as drivers transporting residential heating fuel are providing assistance for the emergency or for a period of 30 days. On the topic of emergencies, the FMCSA declared a regional emergency for 8 states related to the transportation of gasoline, diesel, and jet fuel. The declaration also comes with driving time exemptions for those transporting gasoline, diesel, and jet fuel. The 8 states affected by the emergency order are Colorado, Kansas, Nebraska, New Mexico, Oklahoma, Texas, Utah, and Wyoming. The FMCSA said the cause of the shortage were due to a combination of high demand, severe winter storms, and the unexpected shutdown of a Colorado refinery. Then we'll step away from emergency declarations and end our news segment on a bit of a happier note. For the second straight year, J.B. Hunt Transport, a subsidiary of J.B. Hunt Transport Services, has announced that they will award appreciation bonuses for their full-time company drivers and full-time hourly maintenance and office employees. The amount awarded will total nearly $9 million. Now for a peek at the overall economy with a look at 3 things you can expect in February. Here's Michigan State University's Associate Professor of Supply Chain Management, our good friend, Mr. Jason Miller.
Welcome, everyone, to talking a little bit about macroeconomic indicators right now and what they mean for trucking as we move into the month of February. What I want to do today is share with you sort of 3 big pieces of information that I'm looking at as we're trying to get a sense of how the freight market's going to evolve as we move into the year. First up is this issue of consumer inflation, which is so important because that's going to be affecting how the Federal Reserve Board raises interest rates. And on this front, we actually have some good news. And what we have here is sort of 2 different pieces of data. One is the consumer price index for all items in the United States, excluding shelter. And the reason for that is because there's some complexities with how housing is included. Here's the good news. Prices appear to have stabilized overall from sort of a peak in early June, and we've actually been flat since then. So while we've had tremendous inflationary pressures, over 15% since the start of the pandemic, the good news is we're finally starting to seem like we're getting consumer inflation fairly well under control, barring something odd happening. And this is also showing up in business prices. So the price firms receive for their products. So I've got some additional information showing the price of final demand finished goods. So those things that we go buy at the store. Those prices have flatlined really since about June. The inputs that those companies utilize. So if you think about it, you're a canned, tuna manufacturer, your inputs are going to be tuna or, metal cans. Those inputs have also stabilized at essentially the same prices we've been at in June. So not deflationary, but not increasing. Lastly, if we look at those inputs used by the canning manufacturers, so let's say things like aluminum, we actually have been in a deflationary cycle since about a peak in April or May. So right around sort of the peak at commodity price concerns with Russia's invasion of Ukraine. What this means is it seems like overall consumer inflation is starting to come under control. That is a good sign for us from a freight standpoint because that would mean the Federal Reserve Board doesn't have to be as aggressive in raising interest rates. Because one of the sectors that has been most affected by the interest rate increases has been single-family housing. So what I'm sharing here is 2 additional plots talking about what's going on in the housing market, and specifically single-family housing. In 2022 was a Jekyll and Hyde year. We started the year very, very, very strong through the first 4 months. Actually, more housing starts than even took place in 2021. However, those sharp interest rate increases caused a very quick downturn in housing activity, where housing essentially fell about 16%. New housing starts fell 16% to revert back to their 2018 and 2019 levels. This took a lot of freight out of the equation, a lot of lumber, a lot of shingles. It also pulled down the demand for imported furniture, imported washing machines and dryers. Now, December's reading was actually a little bit of a good sign. We actually did see sort of an unseasonably large increase in new housing starts. So hopefully that indicates that we may have bottomed out around November. So that's a hopeful statement. Now, the one thing to keep in mind, though, in comparison that we have this time around versus, let's say, even 2019 when housing slowed, is we have so many additional starts that need finished. Almost 300,000 more houses are being built today. So they're under construction than what were being built in 2019. We still have to finish those houses. So that's still going to be freight that will need to be, handled as we move into 2023. But we have to watch those starts because that's the thing that really seems to trigger a lot of importing activity, triggers a lot of, sort of original freight activity. And then the last thing I'm watching as we move into this year is overall a major concern in that the last 2 months of 2022, we saw a sharp downturn in the very cyclical part of manufacturing activity that produces durable goods. So washers and dryers, lumber, things of that sort. And that is concerning because when we look at the prior two freight recessions that we experienced in 2015 and 2016, as well as 2019, they were led by a downturn of durable good production. So we're going to have to wait and see how that plays itself out. Now, that doesn't mean, though, that all sectors are hurting. And the one key message I would say to carriers as we move into 2023 is know and understand what is going on in your different shippers' verticals. For example, aerospace product and parts manufacturing is poised for a very strong year in 2023. As Boeing is ramping up production of airliners, we have a lot of defense spending taking place. And so if you're serving shippers very exposed to that sector, you should be seeing good freight volumes this year. And so that is the one thing to keep in mind. We certainly have sectors of manufacturing and freight in general that are weak, very much things tied to single family housing, but we also have some sectors that are poised to do well. And so it's incumbent on you to identify what are those sectors and try to structure your freight mix accordingly as we continue to move in through bid season.
All right, thanks for that, Jason. That's a lot of really great information. And you mentioned the aluminum prices were down and saw a bit of deflation in the pricing, but elsewhere the inflation numbers were rather stagnant. Do we have any idea of when the inflation may actually not only stop, but begin to decline?
So right now, I'm not looking for much of a deflationary environment for two reasons. First, historically, even in the worst of the Great Recession, we saw a deflation of only about 1 to 1.5%. And we're talking that's at the bottom of the Great Recession. And we're not looking at an economic slowdown anywhere close to that. Second, right now, we have the strongest wage growth that we've observed going back to the early 1990s at over 6% right now, according to the Atlanta Federal Reserve. And so with that, that is going to essentially counteract decreases in material prices. We're going to be seeing that increase in labor sort of as a counteracting force, especially in the services sector. So for me, the best case scenario for inflation as we move into 2023 is by about June and July, when we start getting it up against those, very rough numbers from 22, that we're essentially neutral. And so I don't see deflation, but I do see the possibility that we could be at 2% year over year increase in June and July of 2023 relative to 2022 for that broad basket of items.
Okay, all right. Well, I guess neutral or close to flat is better than more huge inflation spikes. What about the durable goods you touched on? You said that durable goods have been kind of an indicator as to what's going to happen with the economy moving forward. Taking a look at those numbers, how much longer do you think it'll be before we get a firm idea of what's going to happen?
So I would say it will only take a couple more months to really give us a sense of whether we continue to see that downturn in durable goods activity. One of the indicators or one of the sectors that we'll often look at is steel production, and that has not been doing as well. But, and this is the caveat, the steel mills have been very strategic about taking some capacity offline for planned maintenance, so it's a little harder to read into that. But I would say if we see another rough month in January on the Federal Reserve's data, then I'm really going to start to worry with that. We, had a good December from a new orders standpoint. Separate Census Bureau data showed a sharp increase in new orders. But again, that was heavily driven by Boeing having a banner month for booking commercial aircraft sales, which while that is freight, on a tonnage basis, there's not that much freight in that, and it is very specific to a couple sectors. So I think we'll see on that durable goods side. I think we'll know with January and February housing starts, if we start to see further dipping down towards, let's say, 2017 or 2016 levels, then we're going to know it's going to be a rough 6 months. I do know a lot of the carriers in their fourth quarter earnings results are saying they're hoping for a second half uptick. I'm a little bit more cautious about that because we do have a major inventory overhang, especially actually in wholesaling of things like appliances. And so I really am just looking at that single family housing starts data to see if we see an uptick and if in turn that's going to start driving demand for freight. Because I think until we start to see housing strengthen, it's hard to make a case that 2023 is anything but a blah year.
And that's our show for this month, everybody. You can find the links to all the stories we covered and a more in-depth look at the recruiting data we went over today down below. If you have any questions or would like to talk with one of our associates about your particular hiring needs, let us know by filling out the form below and scheduling a consultation with somebody from our team. We look forward to you joining us again next month for another 30-day reset. For Randall Reilly, I'm Joshua Miller. Thanks for watching.